Who pays the income tax? Yay, right? In a proprietorship, the owners pay the income tax. The proprietorship itself is not liable for income tax. The owners include the income of the corporation in their personal income tax return and pay the taxes on it. In a partnership, the partners include their share of the partnership income in their personal income tax return and figure the taxes including their share of the income tax, or the income, net income. Now, corporations, there's two types of corporations. There's an S corporation and a C corporation. In an S corporation, the shareholders include their share of the net income in their personal income tax return and pay taxes on it. The only business entity that pays its own income tax then is the C corporation. That's it. No other business entity pays the income tax on their business's income. Only the C corporation. Okay, one other thing I wanted to say about this is there are two other types of legal structures. There's what's called a limited partnership and there's called an LLC. These are simply hybrids of a corporation and a partnership. For your purposes and my purposes, this is very simple because accounting and taxes are treated like a partnership. It's only the legal issues that differentiate between an LLC and limited partnership. Who's at risk? Okay? In a limited partnership, there's got to be at least one limited partner and one general partner. Can't have a limited partnership and not have any general partners. You've got to have at least one of each. It's very uncommon today. Limited partnerships are very infrequent. Limited partners have very limited risk. The worst that can happen is they might lose their investment, but they're not at risk for additional loss. And a general partner has unlimited liability. Okay? General partner could lose it all. So if you only have one general partner, that general partner is just like a proprietor. They stand at risk 100%. Whereas a limited partner might not have any additional debt. But limited partnerships are uncommon. Again, accounting and taxes for a limited partnership is just like a partnership. So no difference. Accounting is the same. Limited liability company is our new baby around here. Limited liability companies were first formed in Wyoming back in 1977. Then someone asked, I wonder how the IRS is going to tax a limited liability company. So the State Attorney General's office sends a letter to the IRS saying, how are you going to tax it? It took 11 years for the IRS to respond to that letter. And until they did, nobody else would touch an LLC. In 1989, they responded and said, we're going to treat it just like a partnership. Since that time, nearly every state has come on board and accepted limited liability companies. The problem is they're not standardized yet. Now, the main difference from an LLC is the partners are members. They're not partners. They're just perceived as members. They work together the same and so forth. They're just like a partnership from that perspective, but they're called members. The LLC is supposedly protecting members from liability, such that if the LLC struggles and financially is at risk, supposedly the members are protected, just like a corporation. Okay? Set up like a corporation. You go file what's called the Articles of Organization, not the Articles of Incorporation, like you would a corporation, but they look almost identical to an Articles of Incorporation. They're 2 pages long generally, and they just fill in the blank stuff. They're called an Articles of Organization. Brand new form of business, but they're not standardized among states. And that's the biggest problem we have with LLCs is you might be an LLC in one state and not in another. They might consider you a general partnership in another state. And when you're a general partner, what happens to that personal risk? 100%. So you have to be a little bit careful if you do out-of-state If you have out-of-state companies that you work with and so forth, LLC is a little bit more risky. It is getting better and better. I'm still not a real fan of LLCs, but I do recognize that they don't require the note-taking. At least they're not supposed to. You don't have to keep minutes, and you don't have to run it with the board of directors. The partners have a lot more say in what goes on without going to the board of directors. The money is yours. You can take it out as draws as opposed to getting a salary and so forth. So it's a little bit easier to work with. But until the courts have completely standardized this thing, I'm just a little bit leery of it. I'm still working with that. I think a corporation's been around for over 100 years. It's been tested, proven, and so it's a good system right now. Before you put everything away, will you turn to page 3.1 and tell me what type of legal structure City Cycle is? 3.1. It was that balance sheet that we've looked at a couple times before. It's a corporation. How'd you know that, Kathy?
The capital section.
Yeah, the capital section. Common stock, retained earnings, those are corporate accounts. Turn to page 2.1. What is it? Sole proprietorship. How do you know that? That's right. If it were a partnership, you'd expect to see multiple equity accounts and drawing accounts, but it only has one, so it means it's a proprietorship. Do you see how we work this? Okay, great way to go.